Wednesday, March 31st, 2021, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Tavi Costa. He's a portfolio manager at Crescat Capital in Colorado in the US. Tavi and I spoke back in September last year. Doesn't seem that long ago. We spoke about how silver was so undervalued back then. And it's still really undervalued now, especially the paper prices. And it's great to have Tavi back. Tavi and I have something in common. We both grew up in Brazil, of course, at different time. I'm young, a lot older than Tavi, and he's now in the States. I'm in London. And yes, Tavi, what would you say is the most important thing you're looking at right now in terms of not just fundamentals, but the technicals for commodities, overall markets, the dollar, and maybe also a little about inflation? There's a big debate right now going on about inflation. The Federal Reserve seems to think it's just temporary and that we shouldn't worry about it. Bond market, not so much.
Yeah, well, thanks for having me, Monaco. It's a pleasure to be here again. Look, there's a lot of things that I'm watching here, but most importantly is I think part of our investment process to try to discern the narratives that are out there. And there's two very prevalent today. One, this is the roaring 20s, and the other one is the risk of a liquidity crisis. And both have a lot of valid points that we agree with, and some others that we think there are flaws. And from the roaring 20s, certainly is a more reflationary and healthy recovery for the economy thesis, where certainly we've seen this improvement in households, where net worth of the bottom 50% has improved the most, not just in a quarter, but also in an annual basis. In the middle of a recession, we've had personal income is still relatively high, even though it dipped a little bit in the last report. It's still significantly higher than historical average. I believe still rising at a 4 to 5% year over year. We have savings that are really high, where it sort of shows that there's a lot of cash in the sidelines, even though the immediate reaction of looking at that number is that it's deflationary, but there is a lot of cash in the sidelines. But where the flaw is of the roaring 20s thesis is thinking that the economy is at the bottom of the business cycle. And a clear sign of the issues that we have is exactly this increase in interest rates that we're seeing, sub 2% in the 10-year yield. And we're already seeing a large sell-off in equity markets, or at least you can definitely tell the fragility in the system by looking at how the market is reacting to such an increase in interest rates. So that is one of the narratives. The second narrative to me is this liquidity crisis or the deflationary thesis in general, which is also valid in a lot of ways. There's certainly a lot of speculative bubbles out there. Almost every asset class that you look at is at record valuations, aside from commodities. And so the reckoning of all those imbalances certainly is supposedly the financial reset, as we see throughout bubbles. Bubbles, they burst, and when they do, it's deflationary. And so there is to be made for the deflationary thesis here, which we believe as well. And the whole idea that even QE is not necessarily money printing that leads to higher consumer prices. Well, I can kind of understand the complexity of that and appreciate some of those thoughts. And we certainly have had an inflationary period of assets in general, financial assets especially, but not so much like we saw in the 70s in terms of consumer prices, taking out, college tuition, medical costs, and some other things that certainly have moved up in the last decade or so. But the large reason why we haven't seen inflation, and where I think the deflationists really are underappreciating this part of what's going on, is the social and economic impact of the combination of the fiscal and monetary policy that we're seeing today. The two, with just wealth transferred from the government to the people, it's not like again, it's not like the economy is doing better. What we're seeing is that we just relocated the imbalances from the private sector and put it on the government side. And that's why the government's piling on debt over debt with deficits that are in the worst level since the World War II. At the same time as the economy is heating up, and monetary policy, as both of us know, was originally designed to control money supply relative to how the economy was accelerating or deaccelerating. And in this case, we're seeing acceleration while almost every single policy out there, from money supply growth to expansion of the monetary base through the purchases of assets by the Federal Reserve, we're seeing zero interest rates, and we're seeing the suppression of interest rates by the Federal Reserve. And the deficit situation too, and this helicopter money policy. So at what point do we see a beginning of a long-term inflationary cycle? There is a very high probability, in my view, that we might be triggering one in case the Federal Reserve does not tighten conditions here. And if it does, and that's why I call it why the Federal Reserve is trapped, if it decides to do that and decides to tighten liquidity conditions, what it's going to cause is that most likely those risky assets at record valuations don't deserve to be where they are. So it's a very tough scenario. It's exactly why we're long commodities and short equities, where we think that that's the sweet spot between those two narratives.
Yeah, and the Fed, they've kind of, you said, boxed themselves in a little bit. They're trapped because they've been saying that they're going to keep rates at zero, at least the short-term rates up until 2023, 2024. It almost feels like they want to trigger some kind of inflationary, cycle. Maybe to write off a lot of the debt that has been taken on, by government, not only since March last year, but since 2008. And we're seeing as well, just announced today, they want to implement another $2.25 trillion in fiscal stimulus, even though they're saying they're going to fund that by taxation. But that can't be a good thing, because if you have a government debt that's already soaring and you tax the private sector, how do you think they will be able to keep all this going? It's just so crazy to me. This roaring 20s idea, yes, maybe they're comparing it to World War I, the fact that there's pent-up demand, so they're comparing the pandemic to that. But I think it's really tough to see what's going on. One conundrum, I think, or maybe we precious metals advocates are always like maybe too enthusiastic about things. Maybe we discount too much things. But how do you account for for gold and silver having had such a tough time since around August, September? I know commodities, actually, they've done really well since then. Lately, they have corrected a little bit. Have you got any views on that, about precious metals and why we've lagged so much?
Look, my views are basically unchanged in a way, meaning I'm still very bullish on precious metals. I thought cyclical commodities, and some of them specifically, had a good shot of doing well after elections. And I'm not just saying that because it actually happened, but it was this green agenda now post-elections seems to be gaining force. And I think by that, there's a chance where oil and copper and some other commodities that actually have been out of favor could have done well. And we saw a run up, and now we're seeing sort of that pause. Can the pause be as long as what we saw since the pause of the precious metals right now? It could, but I don't think it will. I think when I said the Federal Reserve is trapped, I actually really mean it, because look, from the government side, it can only keep up with this levels of deficits and the issuance of treasuries if there's a buyer, and the only buyer of last resort has to be the Federal Reserve at the end of the day. So it has to expand its monetary base to purchase those treasuries and therefore drive interest rates lower, allowing the government to continue to spend and being in the spending spree as we've seen so far. And so I think the Roaring Twenties relationship that you were talking about, what that really misses of this whole thesis of the being bullish is the difference between reflation and inflation. Well, reflation it tends to happen at the very bottom of a cycle where prices are getting back to recovery levels. And so we see a healthy move of acceleration in the economy that causes that. I don't think that's the case here. And in terms of the Federal Reserve being trapped, well, look, back in the days, the Federal Reserve and central banks in the world were able to get away with a lot of money printing without really boxing themselves into a real corner here. But this time around, it's going to be, in my view, different given the size of the policies and the level of commitment. Certainly macro imbalances are deflationary. However, the response to those imbalances has been truly unprecedented in terms of the inflationary response that we're seeing. And so I think that's going to drive inflationary forces higher. And it's important for investors to look back in history and see the other decades that we've had in the past that were actually inflationary decades. There were really two of them, the 1910s and the 1970s. And some may be thinking, is he crazy? Is he not considering 1940s? Well, the 1940s had sporadic moves of CPI, and I know it's understated for inflation, but it's what we have for calculating consumer prices as a gauge. And during that time, we saw sporadic moves from inflation, high inflation, to even deflation in that decade during the World War II. And so now 1910s and 1970s, if you calculate the median CPI throughout the whole decade, you have that is well above, or actually it's above 6%, which is by far larger than any other decade compared to, for instance, the 1940s, which was at 3%. And so if you look at the annualized return for equities during those two decades, the 1910s and 1970s, you have basically a sideways market where annualized return was somewhere close to less than 1%. That is not including inflation. If inflation was running at about 6%, well, then what you have here is that real returns were actually negative for those two decades. I don't think the investors of today's economy here are really ready for anything like this. We've had markets being propped up by central banks for a while, which have not really seen the cost of doing that so far, aside from the bubbles that we have, speculative bubbles that we have in a lot of assets in general, especially the equity markets, corporate bonds, and even sovereign bonds. And so how do we unwind this? The Federal Reserve and central banks are able to do that until inflationary forces begin to pick up. And I hear a lot of people saying, look, but who's causing the bond market to be pricing in inflation expectation to be rising is the Federal Reserve, because they're the ones buying tips, right? They're buying the tips market. They own close to 30 to 40% of the outstanding tips in the US. And so why are they doing that? I don't think they really have an option. It means that investors are actually worried about inflation, and they're picking to buy something that is protected by inflation versus something that is not. And so the whole point is that if you look at break-evens, they have been rising, that are actually pricing in this movement of the purchases from the Federal Reserve. And a lot of people are saying, look, you're looking at break-evens, which is a calculation of what you think the CPI is going to be at whatever maturity it is, 2 years, 5 years, 10 years, you pick. And they're really doing that in the 5-year, because the 5-year has been moving significantly in terms of inflation expectation. And what we're seeing so far, to answer your question, since the precious metals have been declining, which is kind of interesting, is the fact that we saw really real rates moving up, not lower. And the reason for that is that nominal rates have been moving higher, but inflation expectation, it still continues to go higher, continues to move on the upside and not the downside. So I think the nominal rates movement is is sort of inevitable to the upside, but will be matched along with higher inflation expectations. It would be a nightmare for the Federal Reserve and the government to have real rates moving higher, as it would be very difficult for them to justify this situation to fund the amount of debt that we have here in the US. And so I think the Federal Reserve does not have an option. It has to drive inflation expectations higher to accommodate higher nominal rates as well.
Well, so you think, because I thought some years ago the Fed, they were talking about selling volatility in tips in order to keep inflation expectations lower. But so you think they're buying the tips now to increase the nominal interest rates in order to write off the debt? Is that their policy, you think?
I think they're buying tips in order to justify a possible raise in nominal rates, and that's what we're seeing. That would be my answer to that. Look, I don't know. I'm just speculating what I think it is. But I think for the equity market and any other market, it would be difficult to justify very, very high valuations with nominal rates rising. But even worse than that would be if real rates are rising. So that's where the issue really is.
Yeah. And what about, do you think, because today is the last day for that SLR exemption, and there's a lot of talk that the Fed could institute yield curve control, but yield curve control is like targeting yields and hoping the market respects those levels. But if the market challenges those levels, the Fed would have to step in and do more QE. Do you think they're going to have a tough time doing QE now that the SLR is going to not be exempt for the big banks?
No, I think they're going to have to continue to, but it's still somewhat of a tightening policy by anything related to removing some of that as a continuation of the support in the economy. But at the end of the day, again, if they're buyers of treasuries, then everything is fine and we're good to go. But I don't think that's going to be the case. I still think the Federal Reserve is going to have to come in a significant way. Otherwise, rates don't deserve to be a sub 2% on the 10-year rates. They're supposed to be much higher. So we all know all those rates are manipulated. And in terms of yield curve controls, it's important to know that the Federal Reserve is already buying a lot of the longer duration bonds or treasuries as of today. It does mostly between the 5 to 7 range, but there's a significant amount of purchases on a 10-year, even 30-year already going on, which is very different than what we saw at the beginning of the pandemic, when most of the issuance of treasuries and purchases from the U.S., from the Federal Reserve, were in T-bills, and so which are short-term maturities. And now they're moving away from that to be buying most of the longer maturity ones. And so that's the big difference in my view. But a yield curve control is sort of already happening. I mean, it's been 6 weeks in a row where the Federal Reserve exceeded its 120 billion amount of QE for 6 weeks straight for, of 4 trailing weeks. And so remember, they said they were going to do 40 billion of mortgage-backed securities and $80 billion of treasuries. And so they've been doing more than that already. And part of this is actually being mortgage-backed securities. They've been buying more than they used to in the last months. And I think it has a lot to do with this inequality problem and how everything is a house of cards, right? What we have is rates moving higher, nominal rates, causes mortgage rates to go higher. So the Federal Reserve has to buy mortgage-backed securities to try to drive, financing for real estate to cheaper levels. And so, it's a very tough spot where they are. And if you remember, continue to buy mortgage-backed securities is perfectly in line with the inequality problems, because the bottom 50% of the population owns over 51% of their assets in actual real estate. And so they hold a significant percentage of their net worth in real estate relative to the rich parts of the society, which own most of their assets in financial assets. So as part of this, propping up housing markets, even though it would also help the richer in higher classes in the U.S., would certainly be in line with helping the lower classes. And so they don't have much of an option. So we're seeing a wealth transfer to the lower classes of the U.S. And so, what we see usually, as you know, you're from Brazil as well, is that when you give money, especially to the lower classes, they tend to spend money. And so that drives inflation. So we think that's the difference in the dynamics of macro, especially the monetary and fiscal policies relative to what we saw back in 2008, when the lower classes lost close to 84% of their net worth. And this time around, we're seeing an increase, not a decrease.
The real estate market in the US is booming right now. I saw something on Zero Hedge today, and in the UK as well. We've had, and they're focusing as well on giving people here that buy houses under a certain amount, £500,000, which might sound a lot, but in Greater London, £500,000 is not, is just above the average house price. And we're seeing, I think I saw some data earlier this week that mortgage lending is at the highest level since the '08 crisis here as well. So it definitely seems like they're trying to keep the general public flush with cash. And also all the stimulus, the checks, and now they're talking about another $2.25 trillion of stimulus. It seems to me that especially with the political change, that the people in power now, they don't trust the free market, and they're gonna transfer all this wealth and try to allocate it with all these government schemes. And I think it will most probably help the GDP numbers, the statistics, but going forward, I don't see that as healthy. And as you said, the lower classes, the people that are at the bottom of the economic ladder, they tend to spend a lot more instead of investing. And so I think the talk of reflation is a little bit wishful thinking. I see more stagflation after 12 months, 18 months of all this stimulus. What do you think?
I think it's very possible. I mean, I just don't know what's going to happen in terms of the Federal Reserve. So I respect the probability game, because I think it's all possible. So meaning, from a positioning perspective, being long commodities and short equities makes sense, because if you have a deflationary bust, I mean, who knows? So the last two recessions, the response from the Federal Reserve was to hike rates when the economy was heating up. Are we going to see the same today? So back then, that change in stance of policy actually triggered the economic downturn that we saw in the tech bust and the housing bust in the U.S. and globally. And so, is that what we're about to see today? Did they supposedly learn a lesson, and will not perhaps raise rates this time around and tighten significantly and causing an economic downturn? Will they allow the economy to run hotter? Seems to me like this whole conversation about inflation is just transitory, is going to the side of let's allow the economy to run hotter for longer. And if that's the case, the longer that goes, the higher the probability of entering a long-term inflationary cycle. Again, as you know from Brazil, you also are very aware of inflationary forces. When they really begin, it's over. It's very difficult for you to have control over it. One thing is to have inflationary forces at 2, 3, 4%, but that's not what we're seeing right now. A CPI at 1.7 or so, 1.9% year over year. That's a joke relative to almost every commodity being up over 10% on a year-over-year basis. And so, and so many things. I mean, it's hard to find anything that is not up at least 10% on a year-over-year basis. And so, for me, certainly the economy is running hotter than what a lot of people think. The pandemic issues certainly added to this in a way of the economy running very well below its industrial capacity, which is, again, go back in history, 1919, during the Spanish flu, what do we have? Well, we had an issue not with aggregate demand that was rising. It was really aggregate supply that was so constrained because nobody was able to produce anything. Does that sound familiar? And so,
Yeah.
it's the same way, I think, in my view here. This is playing out the same way. By the way, I was just looking at the ratio of inventory relative to sales of the U.S. in different goods, and what you find is that certainly this ratio is at a decade plus low right now, and so sales are increasing and inventories are not matching that same increase or the same improvement. So as the economy reopens, if we will reopen, which I think we probably will, I think there is one part of that roaring 20s idea that is correct, which is the pent-up demand with the cash in the sidelines will probably drive inflation. That does not mean the economy is doing great and we're going to see organic growth. Again, we just relocated the problem from the private sector to the government side. We still got to deal with the government debt and the deficits. And as you said it, the other little earlier about taxes, that Federal Reserve cannot take the whole thing together. So it's going to have to be through taxation of the taxpayers in general.
With all the growth in aggregates like M1, M2, and even M3, do you think that could lead to like a loss of confidence in the dollar? Do you think the fact that some countries are like trying to get away from the dollar as well, not just because the U.S. has been using it as a weapon, but because they see that the U.S. is going to continue to print, continue to spend. How do you see that going forward? Is there a danger because we hear a lot about hyperinflation as well of the dollar that would lead to hyperinflation everywhere? I mean, it's something that people only think can happen in Venezuela or Zimbabwe or Brazil. Do you have any view on that?
Well, I think usually the reason why we see emerging markets, especially even frontier markets, having issues with hyperinflation has a lot to do with the faith in the political environment, along with their own currencies, and that's a big deal when you start seeing money moving away, especially bigger companies and larger institutions trying to relocate their businesses out of those places. Certainly something we saw in Venezuela, we're seeing in Argentina. We could potentially see in places like Brazil. And so when the smart money begins to leave that geographic location, it drives especially the local currency puts the local currency under pressure. And so that's really when we start to see commodity prices in local currencies to rise. And that's the beginning of a problem. And where a lot of people, for instance, that analyze Brazil and tend to see the situation with, especially what we're seeing now with commodities being perhaps in a super cycle here in the beginning of one, and investors trying to, focus on places like Brazil as an opportunity to invest. What they forget is that Brazil exports raw materials, but also has to import a significant amount of final products. And so the depreciation of the currency of the real or any other emerging markets in most cases actually hurts their own inflationary forces. In other words, it creates, it's like almost like a feedback loop, and where the reflexivity of that creates inflationary forces from the declining of the currency. Now, going back to your question, if that can happen with the dollar, it's a probability game again, and there is a probability for a hyperinflation scenario. I think it's very low. I'm going to have to say that I think it's very low. I don't need to be right on that. I think if I'm right, if I'm wrong on hyperinflation being low, I'm actually going to make probably a lot of money on that trade, regardless of being wrong on the understating the probability of that. But I just think that there's not a lot of alternatives outside of the U.S. And so when you look at the political issues that we have in Europe and Canada and Australia, in places like Japan or China and so forth, are just as bad as here in the US. And so I don't see an alternative for it. So I still appreciate the fact that I think the US dollar is relatively stronger than other fiat currencies, not other hard assets. And so as a fund, what we try to do is to look for overvalued currencies where we can not only be only along hard assets, tangible assets, gold, silver, and so forth, relative to the dollar, but also relative to other very overvalued currencies, such as the Brazilian real. When you buy a gold and silver miner in Brazil that is paying their costs in Brazilian reais, well, basically when the currency depreciates, their margins are improving, and they're also selling a hard asset. So, everything here is moving along the right way, I believe, if those currencies continue to depreciate. So I think there is a case for, I think the Brazilian real will continue to depreciate. And I think there's a case for a lot of emerging market currencies that will continue to depreciate relative to the dollar. So I like actually the dollar relative to other currencies. But I think we are in a race to the bottom with all fiat currencies. And so, I much rather own gold, silver, monetary metals, any tangible asset that will protect you against the devaluation and especially dilution of money that we're seeing worldwide today.
Yeah, I've been looking at that, all the fiat currencies and how they're all sinking really versus hard assets, especially gold, since 2007. And I think it's a bit of a distraction to focus on the dollar versus other fiat currencies, even though the dollar index has gone up. Because if you look at the last major bottom in the dollar index was in March 2008, just above 70, and now we're around 93. And gold at the time was at 1,000, and it's now 1,700. So I see that as well. They're all sinking together. And I'd like to remind people, we're not giving market or investment advice. This is just our opinion, and hopefully it will help you make your decisions. Aside from buying physical gold and silver, what would you say right now in terms of the miners, not only gold and silver, but also maybe also some commodity sector stocks? What are you looking at these days, Tavi?
Well, as a fund, we shifted away a little bit our focus. Well, obviously, this is a macro trade at the end of the day, being long, or this whole global debasement, fiat debasement thesis. But when you look at the best ways to implement this trade, when you're constructive on commodities, specifically monetary metals such as gold and silver, the first reaction is, yes, let's buy physical gold, physical silver. But if you think that the price of the metal is going to increase, your next step here as a sequence of analysis is to look at the miners. And a lot of investors have been looking at the large miners, the Barricks and Newmonts of the world. Those are great investments in our view, but what we wanted to really focus on is what we call a supply cliff issue, where we view a lot of companies in different areas of the majors where we see a depletion of reserves happening already, with not a lot of investments in exploration and development of new mines. And so that's going to cause a problem of a supply shortage of some of those commodities. And so in our view, it's time to be focused on the very early exploration stage of the business of this industry. And so we've been looking at projects in strategic geographic locations, in parts such as the Golden Triangle or the Newfoundland, or in Nevada in the West, or we like Brazil, some parts of Bolivia, some parts of Mexico, some parts of Peru, Australia, and so forth. So we've been looking for very interesting projects that have a significant amount, hopefully, of gold and silver in the ground. We've been approaching this with more of an activist style, a friendly activist style, where we help those companies to not only infusing capital into those businesses, but also helping them to bring up their expertise through our network, and also helping them to tell the story and spend the money in the right places. And so we've had a lot of successes so far, and that's exactly why before this we started recording, we're talking about this decline in precious metals and how we've been able to hide so well and not actually got hurt since the decline of the precious metals industry and the precious metals in itself. The underlying securities have been declining in price, and so we've been able to hide very well by successfully adding value to some of those businesses. So that's really the focus for us, is to come up on a very highly speculative segment of the industry where a lot of investors tend to ignore for being supposedly gambling for a lot of people. But we come in with a very long-term mentality of buying literally properties with very prolific deposits of gold, silver, sometimes even with significant amounts of base metals, where we can hopefully provide a lot of value even for the majors when the time is right and they have to expand their production lines. And so that's really, we're trying to fulfill this gap that we view as a supply cliff issue, where especially now with this small decline here, this first quarter of 2021, is going to be interesting because I don't think, capital, as you probably know as well, has dried up a lot significantly here in this mining industry in the last 3 months. And as a response to this declining in gold and silver prices. And this only continues to exacerbate the supply cliff issue. So I'm very excited about those.
Yeah, and I saw a story the other day that I think you might have covered it as well, because Tavi posts a lot of stuff on Twitter and LinkedIn that the mining industry made the most profits ever, even though a lot of the stock prices are not really reflecting that, which is crazy when you look at technology companies that don't make any money, and yet their prices are so high. And I think if the Fed has a difficult time keeping interest rates or yields low, I think it's going to hurt technology even more, and should help commodities and miners. I mean, if you look at the NASDAQ, it topped, I think, in February, and it's actually not doing really well. It hasn't confirmed the new highs we've seen in the S&P and the Dow of late. And I think that's not a good sign for the overall stock market, because the NASDAQ has been the driver in this bull market.
Yeah, I agree. Well, it's, the value proposition of buying a tech company relative to a miner in a free cash flow basis, especially free cash flow yield, including the enterprise value of those businesses, you find that today miners are actually cheaper than those tech companies in general. So I find that pretty interesting. And I think there's a lot of people not doing their own homeworks in terms of the fundamental analysis. And that's just part of the game. At some point, I think people are going to catch up to this idea. We've seen miners really having to reduce their costs and really cut down in terms of their spending and not being capital destroyers anymore. And they certainly have not been in the last 5 quarters. At least they have reported for the first time 5 straight quarters of positive free cash flow. In fact, record free cash flow, as you just pointed it out. Balance sheets look a lot cheaper, a lot stronger. And the other part of it is, remember when they used to dilute capital like crazy? Well, now they're actually buying back shares. So their net equity issuance is falling, not rising. So there's a lot of reasons why fundamentally, without looking at the metal and prices in general and the imbalances in the macro world, that should drive demand for those. There's really 3 parts of the thesis here. There's the macro imbalances that create the demand. You got the fundamental reasons to belong this industry, but also the supply issues that we saw, given the underinvestments in the space of commodities, along with capex falling and so forth, in a lot of different parts of the commodity space. And so I think it's very exciting. I'm not looking at prices on a daily basis. Some days it's great. Some days it's frustrating. It's important to look at the big picture and try to build a business around this macro thesis.
And I think right now it feels like gold and silver, the precious metal sector is so hated. It's so neglected that it's a really good opportunity. Warren Buffett always said he likes to buy assets when they're really cheap. And I think we're at that juncture. And just to complete our interview here, we can go into maybe cryptocurrencies. I think they're also very, they're on the flip side of precious metals. They can do no wrong. There's a lot of enthusiasm, a lot of predictions of to the moon, while gold and silver are neglected. And people say, well, the cryptocurrencies are a reflection of the weaker dollar, of all the money printing. So how come that hasn't surfaced in precious metals? So I think that's also a pretty good indicator for precious metals, the fact that there's so much froth in cryptos, but not in precious metals. Have you got any views on Bitcoin and cryptos and what's going on there?
Look, I'm not a hater of Bitcoin at all. I think it's a lot of interesting developments going on in that space. I think there is good arguments for the crypto community to be finally, especially millennials and younger people, learning about the issues that we have in the monetary system and the political environment that is incredibly corrupted, and knowing that fiat currencies are backed by those policymakers in general and countries as a whole. And so the need for an alternative is certainly rising, and I think that's all over in this process of hoarding hard assets, especially by younger people through Bitcoin. People are not buying Bitcoin to go in Starbucks and buy a coffee with that. They're buying Bitcoin because they want to. They think cash is trash. They really do. They think it's not worth for you to leave your money in the bank. And so there is certainly a move towards that, which is very telling about, again, going back to this long-term inflationary cycle where it's all, again, it's all a feedback loop where you start seeing really is people beginning to move away from cash and starting to hoard things like hard assets. It drives commodity prices, which are hard assets, higher, and then begins to move inflation expectations higher too. And so that is kind of like what we're seeing right now. And the more that happens, if the Federal Reserve doesn't react, it gets out of control, and that's how you get to the 70s and 1910s types of decades. And so there's a very high probability we're going to see this. And so, so I think it's valid. On the other hand, I think central banks are buyers of precious metals, especially gold, right? Not Bitcoin. And so this whole idea that Bitcoin is going to replace gold or silver is really absurd. And so because they may not be multiply exclusive here, they might be it's okay to have both of them serving different purposes, and so I think it's a sort of unnecessary war and argument between the two. Some people prefer buying Bitcoin rather than gold. Fine, if the equity markets and some of those tech companies deserve to be what they are, maybe some crypto assets deserve to be where they are too. But I much rather focus on gold and silver. And when people say, well, I'm not excited about gold or silver because they don't go up a lot like Bitcoin does, returns of Bitcoin are much better. First of all, I would say watch out for that type of thinking, but that's fine. If that's working for you, what I think it's even more important is the opportunity and the asymmetry in the mining space. And that's why we launched a fund focused on those opportunities where some of the assets that we own have actually outperformed things like Bitcoin. And so that's where I feel excited about is that there is certainly the potential for high returns in this mining space. And I'm not talking about Barrick and Newmont and Kirkland. I'm talking about the smaller cap names where there's a lot of value to be unlocked.
So before we finish, could you tell our viewers where they could look into your fund, Crescat Capital, and how they could, if they're interested in putting money into this new mining fund you guys started and other funds, and how they can follow you as well, because you tweet a lot. You put a lot of stuff on LinkedIn, which I like.
Well, thanks for the opportunity to share a little bit about us. Well, we have a website, Crescat.net, where you can find a lot of information about our prior letters, performances, and all that, and about a little bit about what the fund is about as well. I am also, as you said, very active on social media, Twitter, LinkedIn. On Twitter, my handle is at Tavi Costa, and I also am on Instagram at Tavi Costa Macro, I believe. And so you can find me there. I post things almost daily.
Great. And they can find out how to contact you on the, your fund on the website, right?
Yes, that's right. There's a contact us part of the website. You can always message me as well in any of the social media platforms, as I mentioned. I'm happy to get you in contact with our marketing people. But thanks again for allowing us to share some of what we do and some of our views. I appreciate that, Monaco.
Oh, you're welcome. And thank you for sharing your time with us and to talk about what's going on. We appreciate that.
My pleasure.